Good morning, everyone. I hope all of you are doing great. And today we start with a simple question on business combination. Now, this type of question I would say is a bonus question for the examination. If at all these questions come, you should be in a position to score full marks. That's 15 out of 15 or 20 out of 20 or 16 out of 16. Okay. Now, this particular question is from Jan 21 attempt. And let us have a look at this particular question. If you are getting the audio video clearly, please just comment it in the chat box so that I get an assurance that yes, you are able to listen to whatever I am speaking about, right? Yes, I think the audio video is clear. So let's start. Very simple question, and what the objective of this particular question when I'm solving it in the class is to give you a framework. And if you follow that framework, I'll tell you, even if it's a 20 marks question or a 16 mark question, 12 to 15 marks will be in your pocket. There could be some tricky adjustments here and there, but maximum marks will be able to score. And don't get scared about business combination or consolidation in the examination, because this is the question which can give you good number of marks. Okay, so here on 1st of April of year 17, A Limited acquired 80%. Now, if you actually see, we have to test control, whether control is acquired or not. Normal cases, as I told you yesterday, they will say that they have acquired some percentage. If it is more than 50, there is an acquisition of the share capital of S Limited. On the acquisition date, the share capital and reserves of S Limited stood at 5 lakhs and 1,25,000 respectively. So, now been having again bad throat. Okay, so they acquired S Limited and the share capital and reserves stood 1,25,000. A Limited paid initial cash consideration of 10 lakhs. So first cash consideration is 10 lakhs. Additionally, A Limited issued 2 lakh equity shares with a nominal value, that is face value of 1 per share, and having a current market value of 1.8. Always remember, the consideration that we pay should be measured at fair value. So nominal value is for accounting entries. The calculation of goodwill or capital reserve should be done using the fair value. It was also agreed that A Limited would pay a further sum of 5 lakhs after 3 years, and A Limited cost of capital is 10%. Now tell me one thing, is this payment a contingent consideration? Is this particular payment a contingent consideration? This payment is not a contingent consideration. It is sure that the entity will pay the amount of 5 lakhs to the acquiree, means whoever are the shareholders of acquiree, that will be paid. So, but when are we paying? We are paying 5 lakhs after 3 years. Now, these concepts we have understood in Ind AS 115 as well, that if there is a deferred consideration, in PPE also we have understood, if there is a deferred consideration, you need to calculate the present value. Now, what is the present value? They have said discount rate is 8%, that is cost of capital, and discount factor is given as 0.91, 83 and 0.75. Now, whenever they have given only 2 decimals, you have to use only 2 decimals. Don't start taking your calculator and calculating 4 digits or 5 digits. Okay, if they have given it in the question, you will have to follow that only. The shares and deferred consideration have not been recorded by A Limited. So A Limited is the company which has acquired. A Limited has not yet recorded this particular transaction, means the investment is also not recorded, and issue of shares is also not recorded. Right now, they have given balance sheet, very simple, non-current asset PPE. Oh, investment has been recorded. Sorry, investment has been recorded. What has not been recorded? Shares and deferred consideration have not been recorded. Okay, investment in S Limited 1 lakh, 1,000. I think this is an existing investment. Let us see. Additional information we'll get to know. Inventory 550, receivables, cash. Now, when we are reading the question, the numbers given under A Limited and S Limited actually don't matter. Okay, unless there is a tricky adjustment. What we need to understand is what are the items given in the balance sheet. Equity, share capital, retained earnings. So let me just put out the next part also. Then you have non-current liabilities. Then you have current liabilities. Then on the date of acquisition, the fair value of S Limited's plant exceeded its book value by 2 lakhs. Now what does this mean is, we are talking about S Limited. Always remember, even the assets have to be recorded at fair value. What is the fair value? It is higher than the book value by 2 lakhs. So the impact will be on PPE. This 1500 will have to add 2 lakhs, that is 200. All the numbers are given in thousands, right? Then the plant had remaining life of 5 years at this date. That will be useful for subsequent depreciation. Then consolidated goodwill has been impaired by 2,58,000. Now what does this mean is, when we calculate goodwill, okay, that goodwill we do not amortize, but we test it for impairment. Now that goodwill in the consolidated financial statement has to be impaired by 2,58,000. So goodwill will go down. Correspondingly, my retained earnings will also go down. A Limited values the non-controlling interest using the fair value method. So there are two methods: fair value and proportion of net assets method. Using the fair value method, they have valued it the 20% non-controlling interest at 3,80,000. You are required to prepare consolidated balance sheet of A Limited as at 31st March of year 19. Notes to account on consolidated balance sheet is not required. Now when did they acquire? They acquired on 1st of April of 17. What is this? This is the balance sheet as on 31st March of 19. So the dates you have to watch very, very carefully. Sir, how is 1st of April important? 1st of April is important because that is the date on which you will calculate or you will pass the initial acquisition entry. Okay. Now this investment in S Limited at cost 1000, what they have recorded is only this component. Means the cash payment has been recorded, the other payment has not been recorded. Now surprisingly, 2 years have happened and they give you tricky questions. Now what all we need to do? First is we need to do the acquisition date accounting. Second, we need to calculate what is the value of this particular deferred consideration. That also we need to calculate. Then whether that is goodwill or capital reserve, that we need to calculate. So all of these workings we will do step by step. We'll do step by step, and we'll have a framework based on which we'll be able to solve any type of question based on this in the examination. Right? Please pay utmost attention. Though it appears to be a simple question, it will help us understand a framework, and 15 marks will be in your pocket with this particular question. Right? So now date of acquisition is 1st of April 17. You need not write this in the examination, but I generally tend to write because it helps me create a flow, because sometimes you can miss the date. See, it's 1st of April and here it is 31st of March of 19, right? So we should not miss out on that. Then consolidation date is 31st of March of 19. Right? Controlling stake is 80%. Controlling stake is 80%. Now, when we follow or when we have to calculate what are the various steps that we need to do, the steps can be jumbled. It can be one after the other, but generally try to follow a single sequence or a standard sequence so that you are not confused in the examination. If you try to follow random orders, what tends to happen is sometimes you may follow one order, sometimes you may follow the next order, and in the examination we get confused. So that is what we should not be doing. Follow a single step-by-step process. Okay, first step, step 2, step 3. Like that, when we do, it becomes easy for us to handle the questions in the examination. Now, what I follow generally, the first step is purchase consideration. Now purchase consideration, please remember, includes what all things? What we have paid to the shareholders, paid cash, deferred consideration, any other consideration that will be paid, all of that comes under purchase consideration. Now here, purchase consideration at fair value, cash, they have paid 10 lakhs, so 1000. I'm ignoring the last three zeros because balance sheets have been given in zeros, in thousands. Cash paid 1000. That is the first aspect of my purchase consideration. Then equity shares. Now, how many equity shares have been issued here? They have issued 2 lakh equity shares at 1.8. So, 2 lakhs means 2000, no, 200 into 1.8. If I do, I get 360. Please remember, entry for this has not been passed. Then, deferred consideration or present value of deferred consideration. Present value of deferred consideration, if you see, now consideration is 5 lakhs payable after 3 years. So if you pay 5 lakh after 3 years, what is the present value? Present value will be 5 lakh multiplied by the discount factor of the third year. So 5 lakhs, that is 500 into 0.75, we get 375, right? So these are the consideration. So when you sum this up, you get the purchase consideration to be 1735. That is the first thing. Now, after I have calculated the purchase consideration, then the next thing what we need to move to is to understand what is the net asset, right, acquired. Then we have to calculate the NCI. So now here we talk about the net assets acquired. Step 2. Now, when we see the net assets acquired, how do we calculate? Now, tell me one thing. Has the question given us the detail of assets and liabilities on the date of acquisition? Has the company given us the details of assets or liabilities on the date of acquisition? They have not given us. But what they have given us? They have given us indirectly the share capital and reserves. Now, the way we need to understand this in our balance sheet, when we see, you have assets, you have equity, and you have liabilities. Okay, either the question will give you liabilities and assets. So assets minus liabilities, the balancing figure that you will get is equity. So can I say that equity is also nothing but representing the net assets? Absolutely yes. So the net assets acquired is not given directly, but they have given us share capital on the date of acquisition, and the share capital on the date of acquisition is how much? Is 5 lakhs, and reserves is 1,25,000. 5 lakhs. Reserves is 1,25,000. Okay. This is on date of acquisition. 5 lakhs and 1,25,000 date of acquisition. That is the net assets. Right. Now, on date of consolidation, what is the share capital of the subsidiary? The share capital of the subsidiary is 5 lakhs. Retained earnings is 300. So 5 lakhs, and this is 5 lakhs. This is 300. Now, why am I writing this? This will help me understand what is the post-acquisition increase in net assets. So post-acquisition reserve is, this is 0. There is no change there, of course. This is 175. Now, increase in post-acquisition assets reflects the post-acquisition net earnings of the acquiree. So here, the subsidiary, what is the subsidiary? The subsidiary's name is S Limited. So S Limited has a post-acquisition profit of 175. That is what we can interpret from this particular, analysis, right? Now, after this, always keep a check on if there is any fair value changes. So here the question says that there is a fair value difference, or the book value is higher, fair value is higher than the book value by 2 lakhs, which means whatever is the net asset, I need to increase it by 2 lakhs on the date of acquisition. So increase in fair value is 2 lakhs. Okay, I'll come to the subsequent adjustments, what we need to do slightly later. So when I sum this up, what I get 825 as the net assets acquired on the date of acquisition. 825 as the net assets acquired on the date of acquisition, right? Now, any questions so far before I move further? No questions? Great. Now, subsequently what we need to do is the next part, we have to compare whether there is goodwill or capital reserve. Now, when we have to compare goodwill or capital reserve, we need to compare these net assets with the fair value of the net assets with fair value of purchase consideration plus the non-controlling interest. So, how much is the non-controlling interest? Fair value on date of acquisition. They have given to us in the question that the fair value of this particular non-controlling interest is 3,80,000. So 380 is the fair value of non-controlling interest, right? Now, goodwill or bargain purchase. Fair value of net assets, or you can directly say 1 plus 3 minus the 2, that also can be done. Fair value of net assets is 825. Then fair value of consideration, $1,735. Then fair value of NCI is 380. So the goodwill will be 1735 minus 1735 plus 380 minus 825, which is 1290. Which is 1290. Then there is impairment on goodwill. We'll come to it when we have to handle it. Now, once you have calculated goodwill or bargain purchase, the remaining part of the question is much more simpler and straightforward. You don't need to break much of your head here. But one thing that we have to understand is whenever there is a aspect of fair value changes, we also need to understand what is the impact on depreciation because of the fair value changes. So whenever there is a fair value change, when we increase the value of property, plant and equipment, if I increase the value of property, plant and equipment, the depreciation I should charge should also increase. So what I mean by that is, the subsidiary, see this fair value changes, the increase in fair value of the plant, that is 2 lakhs, that will not be recorded by the subsidiary, but we are recording that in the consolidated financial statements. Now when we are recording that in the consolidated financial statements, subsidiary will charge depreciation as per its own original amount. It will not change the amount and charge depreciation. But when we have increased the value, we also need to increase the depreciation. So whenever there are fair value changes, please keep one thing in mind. There will be an impact on depreciation. There will be an impact of depreciation. Now, what will be the impact of depreciation? We have increased the value by 2 lakhs and it has a 5 years of remaining useful life. Means for 5 years, we will depreciate 2 lakhs. Now, when did we acquire? We acquired in 17. So, 1st of April 17 and 1st of April 18. 2 years depreciation we need to provide. So, depreciation we need to provide for 2 years. Now, this increase in fair value will come with additional depreciation. How much is the additional depreciation? 2 lakhs into 2 out of 5. Sir, why 2 out of 5? Because it has a remaining useful life of 2 years. It has a remaining useful life of 2 years and we have to depreciate it over a 5-year period. So 200 into 2 divided by 5 is 80. Right. Now this additional depreciation will be, you can put it here. That is, subsequently there is a change in depreciation. There is an increase in depreciation, and on the date of consolidation, the total depreciation. This is not add depreciation. Okay, this is additional depreciation. As well, we'll add it. The additional depreciation will have an impact on post-acquisition reserves. See, I have charged depreciation as per my original book value. I actually need to charge depreciation on the revised book value, that is a higher depreciation. If I charge higher depreciation, my post-acquisition reserves will go down. So here, this value doesn't change, it remains 200, and this impacts the post-acquisition reserve, the additional depreciation. Okay. Now, when the additional depreciation impacts the post-acquisition reserve, that is one aspect, and the other adjustment which impacts my post-acquisition reserve, if we go back and look at the question, it says, so first adjustment we have completed. Second adjustment, what it says, consolidated goodwill has been impaired by 2,58,000. Consolidated goodwill has been impaired by 2,58,000. This also impacts the post-acquisition reserves. Now, in the examination, to avoid making mistakes, don't mix this consolidated goodwill with post-acquisition reserves. The reason is, if the goodwill is calculated using fair value method, then both NCI as well as the controlling interest will take the share of loss. But if it is proportionate method, then only the controlling stake will take the loss. NCI will not take the loss. What I am saying is, in this case, here, because we are valuing NCI at fair value, the impact of goodwill will be taken or will be borne by both controlling interest and non-controlling interest. Whereas, in other cases, only the controlling interest will take the hit, right? So, I will not mix it here with reserves. We will do the separate calculation for goodwill. Keep that in mind. Otherwise, there is a chance that you will make a mistake in the examination, right? So, goodwill, it says impaired by 258. So, here we have calculated goodwill impairment. How much? 258. So, closing balance is 1290 minus 258, 1032. Now, I have reduced the goodwill. When I reduce the goodwill, simultaneously or correspondingly, I must also reduce something on the equity and liability side. So, this impairment, if NCI is at fair value, both NCI and parent will bear. Please keep this in mind, right? So, the loss 80% by parent A Limited, that is whatever is the loss, 258 into 80% will be borne by A Limited and 20% will be borne by NCI. That is 258 into 20%. This you will reduce from respective balance in the consolidated balance sheet or when we do the working notes, right? Now, so far what we have done, we have calculated the purchase consideration, We have calculated the net assets acquired. We have determined what is the post-acquisition reserves. So here the post-acquisition reserves works out to 95. Post-acquisition reserves works out to 95. Okay, that is the post-acquisition reserve. How do we split this? This post-acquisition reserve A Limited will take 80%, which is 95 into 80%, and NCI will take 20%, that is 95 into 20%, which is 19. So 76 goes to the parent and 19 goes to the non-controlling interest. Okay, now we have calculated this. Now the next thing is to calculate the non-controlling interest closing balance. Fair value on the date of acquisition of non-controlling interest is how much? 380. That is, on the date of acquisition, NCI has got 380. Now to this, NCI, which is 20%, they will get all the share in post-acquisition profit, any impact of goodwill impairment if NCI is at fair value. So the NCI opening balance, you need to add profits earned. Of course, if dividends are paid, that also needs to be reduced. Profits earned, and the next thing is what is the impact or what is the impact of goodwill impairment, that needs to be adjusted. Now on date of acquisition 380, post acquisition profits will add. How much is the post acquisition profit? 19. This we will add. Now what we will reduce? We will need to reduce the impact of goodwill loss impairment. How much? Goodwill impairment we have calculated it is 51.6. So what is the closing balance? 380 plus 380 plus 19 minus 51.6. Closing balance is 347.40. 347.40. Okay, then that gives us NCI balance. So we have calculated how much do we need to pay to the non-controlling interest, that is the NCI, or how much is the amount which is attributable to NCI, that also has been calculated. Now when we prepare the consolidated balance sheet, please understand the way it works is, whatever is the investment in S Limited, of course this is not the correct figure, we have to increase it also, but for now whatever is the investment in subsidiary, this will be knocked off against the equity. Okay, so whatever is the investment will be knocked off against equity, this particular balance. Here out of this 300, part is post acquisition, part is pre acquisition, that will automatically be split, right? But now please understand, this investment will be knocked off against the equity balance here, and you will have to eliminate both of these and separately take up amounts from the working note to prepare the consolidated balance sheet. Now if you look at the items, we will have an adjustment in PPE, this we need to calculate. Then investment will be not taken, investment will be knocked off. Then inventory, receivables, cash, all of this item on a line by line basis we need to add and prepare the consolidated balance sheet. Sir, but we are talking about business combination. See, the principles of business combination and consolidation are similar. Okay, so inventory line by line, receivable line by line, cash line by line. In the consolidated balance sheet, you will have only share capital and retained earnings from the parent side, and plus whatever is the share in the subsidiary from the retained earnings, that needs to be added. Then non-current liabilities add line by line, current liabilities add line by line, your consolidated financial statement would be ready, right? Now so far what we have done, we have calculated NCI balance, goodwill, those things we have calculated. The next thing that we need to calculate is what is the retained earnings that the parent will have to present in the consolidated financial statement. So what is the retained earnings that needs to be that needs to be considered in the consolidated financial statement. Now here there is one more adjustment, that is they would pay a sum of 5 lakhs after 3 years, that they have not considered, that they have not considered. Now, if this is the amount of consideration on which date? On 1st of April of 2017. On this, we need to charge interest for 2 years. So, this is a working note. Interest on deferred consideration. See, we have agreed to pay deferred consideration. That deferred consideration should be recorded at fair value. Have we recorded the deferred consideration? We have not recorded the deferred consideration. Now we will record the deferred consideration, and not only that, we also need to charge interest, right? So interest on deferred consideration for 2 years at 10% would be how much? So the deferred consideration they have given is, present value is 375. So 375 is the deferred consideration into 1.1, that is 10%, to the power of 2, 453.75 minus 375. If I do, I get 78.75. So this is slightly confusing. Okay, you can do 375 into 10%, 375 plus 37.5, 412.5, 412.5, 10%, 453. Okay, so if you sum this up, you get 78.75. Interest on deferred consideration is 78.75. Now always remember, interest on any liability is my expense. This has to be reduced from the consolidated retained earnings, because my profit will be lower if I charge interest. That is one adjustment. Now, entry on 1st of April of 17, what we have not yet passed, will be debit investment in S, credit equity share capital. How many shares? Need not pass the entry in the examination, just for our understanding. How many shares? 2 lakh shares at 1. So 2 lakh shares, credit Securities Premium 200 into 0.8, credit deferred consideration or financial liability 375. This will be added to your investment in S. So the sum of this, that is 735, will be added to investment in S. Okay, so this is the entry, and for 2 years you will charge interest. First year 37, second year 41, 78.75. Now after we have calculated NCI, the next step would be to calculate, what is the step number? Step 4. So the next year would be consolidated retained earnings. Consolidated retained earnings means earnings of the parent plus share of profit in the subsidiary. Okay, so closing balance, or you can say directly A Limited. Take it from the balance sheet. A Limited consolidated retained earnings is how much? 1400. So this you will take as it is. A Limited consolidated earnings from the balance sheet 140 as it is. Then share of post acquisition, how much have we calculated? You take from this particular step. Share of post acquisition 76. Then please remember, this share of post acquisition already adjusts the additional depreciation, but it has not yet adjusted goodwill. So impairment of goodwill. Impairment of goodwill, our share or the parent share is 206. So this also you will reduce, right? Impairment of goodwill, that also you will reduce. Then this extra expenses of interest which we have not provided, when we provide, it will reduce our balance sheet. So finance charges. How much is the finance charge? 78.75. So this will give us the closing balance of retained earnings. The closing balance of retained earnings comes to 1190.85. Right? And yeah, so we have completed all the workings that are needed, and now we can proceed for the consolidated balance sheet. Any questions? Anybody has any question? See, it's a very simple question. It's not a complicated question, but this gives us a framework on how to approach this kind of question. So anytime you see a question on consolidation or business combination, first thing, what is the purchase consideration? Second, what is the value of net assets? Then, what is the non-controlling interest? If there is any goodwill impairment, are there any fair value adjustments? All of these things you have to check and prepare line by line. Now, once you have handled all the adjustments, just let us do a quick check. Have we taken care of all the adjustments? They said they have not passed the entries that we have accounted for it. Then they gave certain adjustments, acquisition date, fair value, that also we have accounted for it. Then consolidated goodwill impairment accounted, NCI also accounted. So all of these have been accounted. Now we are good to prepare the consolidated balance sheet. Okay. Now when we prepare consolidated balance sheet, few things that you have to keep in mind is that items should be added line by line. So I'll directly do it here itself, and then subsequently just a second. Somehow this got deleted. I don't know, it is getting deleted. So when we prepare the consolidated balance sheet, it has to be line by line, plus or minus any adjustment. Okay. Now I'll prepare here itself. You can again go back and see the actual solution subsequently. Right. Now in examination, what I suggest is have one column for A limited, one column for S limited, then this A limited plus S limited, A limited plus S limited minus any adjustment. So here we'll put what are the adjustment, and what is the consolidated number. Okay. Now first, property, plant and equipment. Now in case of property, plant and equipment, what do we have? In case of property, plant and equipment, we have property, plant and equipment of holding, subsidiary, increase in fair value and the additional depreciation. So here we have 5500 plus 1500 and there is an adjustment. What is the adjustment? We have increased the value by how much? 200. So plus 200 minus additional depreciation. How much is the additional depreciation? Additional depreciation is given to be 80. So plus 200 minus 80, you get 120. If you want, you can prepare a working note below saying property, plant and equipment, A limited 5500, S limited 1500, adjustment 120. What is the consolidated number? 5500 plus 1500 minus 120. So 6880 is the consolidated property, plant and equipment. Okay. Then the next thing is under property, plant and equipment. Please remember, after property, plant and equipment, the next thing you have to keep in mind is investment in S limited. Now investment in S limited, I know 55 plus 15, I have subtracted. It has to be added. I was thinking 55 plus 15 is 7000. How can it be 6880? Okay. Then investment in S limited will eliminate. We will eliminate. When we eliminate investment in S limited, you'll get either goodwill or capital reserve, and you will have to eliminate the equity component of the subsidiary. Now here there is a goodwill. Now what is the goodwill value? Goodwill value we have calculated here 1032. So goodwill 1032. That you can take directly. Then current assets, inventory, receivables, cash, there is no adjustment. So this will be 550 plus 100. This will be 400 plus 200. plus this will be 200 plus 50. There is no change in this. So 650, 600 and 250. When you do the total, what we get is 9652 on the asset side. Okay. Then equity. Now share capital is 2000 plus 500, not 500. 500 has to be eliminated. But the share capital of 2000 does not include shares issued to shareholders of S Limited. So what you'll have to do is, there is an adjustment, or not an adjustment actually, it is a working note number that we need to take. So the share capital that we have calculated, 200 needs to be added. So what we'll do, we will take only parent's share capital, that is 2000 plus 200 that we have not issued. Okay, then retained earnings. Now retained earnings, if you see, we have calculated the retained earnings as how much? 1190.85. Then there is also securities premium. How much? 160. That also we need to add. So this is a new item, securities premium. Now in examination, when you present, you have to present it under other equity, retained earnings and your securities premium. I hope with enough practice you will be aware of how to handle those things. Then we have non-current liabilities. Now non-current liabilities, as far as I say, is 3000 plus 400, which is 3400. Then we have current liabilities. Please remember, the deferred consideration what we have accounted for is not included in this particular balance sheet. Now if the deferred consideration is not included in the balance sheet, how do I handle it? I have to include it. Now whether it is current or non-current, see, it had to be paid from 1st of April of 17 within 3 years. 17, 18, 18, 19, 19, 20. So we'll pay it in the next year. Next year payment means current liability. So it will be 1250 plus 650 plus liability. What is the liability balance? Liability balance is 453.75. So the balance is 453.75. What we get? 2353.75 is the total of non-current liabilities. Now if I do the total, I hope it matches. It didn't match. Why it didn't match? Because we missed non-controlling interest, right? So non-controlling interest should also be presented in the balance sheet after the equity section. So you have non-controlling interest. How much? Non-controlling interest, the closing balance, 347.4. So if you take that, you get 9652. Okay. So this is how step by step you can take and you can complete the consolidated balance sheet, right? Please be careful of adjustments in property, plant and equipment. Please be careful about the fair value changes, that is property, plant and equipment, calculation of goodwill, taking the non-controlling interest, impairment of goodwill, and any other adjustment that may have been given in the question. Now one thing where a lot of students have this problem, I don't know how many of you have, you can put out in the comment box saying yes, we also have the same problem. One problem that students have in the business combination and also in the consolidated balance sheet is balance sheet doesn't tally. So biggest challenge, I think universal challenge I should say, that the balance sheet doesn't tally. Now when we say balance sheet doesn't tally, why doesn't it tally? The balance sheet doesn't tally if you have missed out an item. Otherwise, any adjustment you take, if you have given both side impact, then the balance sheet will definitely tally. For example, here we excluded investment, we excluded pre-acquisition reserve, we brought in what? We brought in NCI and we brought in your retained earnings, post-acquisition retained earnings. Then we eliminated or we adjusted fair value. When we adjusted fair value for PPE, we increased the PPE. We also added the same in goodwill calculation in the net assets. Then when we charge depreciation, we reduce the retained earnings. So when each item you give two-side impact, automatically the balance sheet will tally. A tallied balance sheet will always tally after the adjustments that you have done. The only reason why it will not tally is you might have missed out some item. Now to solve this question, we have taken about 40 minutes. Okay. 40 to 45 minutes, I would say. That is after a detailed explanation. In the examination, 15 marks question, you should be easily able to finish it up in 30 minutes time. Sir, you have Excel, you can calculate fast. I understand that. but I have explained you a lot also, right? So this 15 marks question, you should be easily able to finish it up in 30 minutes. And tell me, where will you lose marks in this question? There is no single adjustment where you would lose marks. Sir, but sometimes we get tricky adjustment. Yes, I know you get tricky adjustment. The way it is marked in the examination, the way marks are given to you in the examination is, for each step you will have marks. Purchase consideration, maybe 1 mark. Analysis of net assets, maybe 2 marks to 3 marks. Non-controlling interest, 2 marks. Goodwill, 1 mark. Consolidated retained earnings, 2 marks. Then, for each item that you prepare in the consolidated balance sheet, for 3 items or for 4 items, you'll get 1 mark. So 4 to 5 marks you will get here itself. Okay, so here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 items, right? About 4 to 5 marks will be for the balance sheet. And for other workings, if you calculate, I'll just give a broad thing. This may be 1 mark, but because there is deferred consideration, they may give 2 marks also. Then net assets acquired, 2 marks. Non-controlling interest, 2 marks. Goodwill, 1 mark. Impairment calculation, 1 mark. Consolidated retained earnings, 2 marks. Just a rough estimate. So if I do this, we get 9 marks here, and as I told you, 5 to 6 marks for the balance sheet, 1 mark here and there. So this is the scope from this particular chapter, and highly scoring if you know the concepts right. Any questions you have before we move further? No questions. Okay, great. So we have solved our question that gives us the framework on how we will do it. All the questions in the study material that has been given, especially the Blue Heavens question and other questions that are available, all of them have to be solved. We'll also solve 1 or 2 more questions. Remaining illustrations you have to try it on your own. Now we'll move to the next important aspects that we need to discuss as far as the considerations are concerned, business combination is concerned. Now, very important, we need to have a basic understanding of Ind AS 102, but even if you have done ESOP based accounting at your CA intermediate level, that is also perfectly fine. That will help you understand this very important part. This has been tested time and again. Mark it as very, very important. Remember the formula as far as the SBP awards which are exchanged are concerned. Now, what is the meaning of this? Let us take one example. Let us say we have one company, Flipkart. Flipkart is acquired by Walmart. Okay, Flipkart is acquired by Walmart. Now Flipkart has its employees. Flipkart has its employees to whom Flipkart has given something called as share-based payments award. We call it SBP. Share-based payment award is something like ESOP, employee stock option. Flipkart has given employee stock option to its employees. Now what has happened? Walmart has acquired Flipkart. Walmart has acquired Flipkart. Now this is a share-based payment, and in a lot of cases we'll understand in share-based payment chapter, share-based payments will be considered as equity, because employees, if they exercise the ESOPs, they can take the shares of Flipkart. If they exercise the ESOPs, they can take the shares of Flipkart. Now what is Walmart doing? Walmart has acquired Flipkart. Now what Walmart says is to these employees, say you have ESOPs of Flipkart. Now Flipkart is no longer in existence, for example. Okay, Flipkart is no longer in existence. So what we'll do is, these ESOPs will not be any use to you. We will cancel these ESOPs and we will give you Walmart ESOPs. So what are they doing? We will cancel the share-based payments, existing ESOPs, and we will give you Walmart ESOPs. Now this is given why? This is given because the entity is acquiring another entity. The entity is acquiring another entity, right? And because it is acquiring another entity, to the potential shareholders, what have we done? We have issued, or we are giving out the equity shares, or we are giving out the ESOP options, right? Now what happens is, whenever there is an ESOP, the ESOP have something called as a vesting period, or there may be a graded vesting also. So for example, Flipkart has given to its employees ESOPs of 3 years vesting period, meaning to say each year some portion will be vested, or over a period of 3 years it will be vested, or at the end of 3 years it will be vested. Some form of arrangement is there. Now 2 years are completed. 2 years have been completed. 1 year is left. And for that 1 year of replacement, what Walmart has done is, Walmart has given its own ESOP, maybe for 1 year, maybe for 2 years, maybe for 3 years, for whatever period, Walmart has given its own ESOP. Now, because Walmart is giving an ESOP, we need to understand how do we account for it in the business combination related transaction, right? So now, an acquirer may exchange its share-based payment awards for awards held by employees of the acquiree. So Walmart giving to Flipkart. Okay. Now, the accounting of it, whenever we issue share-based payments or whenever there is a replacement, that is accounted in accordance with Ind AS 102. It is not that because I am giving a share-based payment award, I will account for it as fair value as per Ind AS 103. No, you'll have to account for it in accordance with the in accordance with Ind AS 103, which is share-based payment. Right now, the awards that has been given will be considered to calculate the consideration for acquisition. So that will form part of my consideration. Right now, how do we account for it? Based on this particular chart, we can say how do we account, or how will we account for the replacement award. Now, first thing is the acquirer obliged to replace? Obliged to replace means what? Is there an obligation for whatever, because of whatever reasons, because of the original contracts, because of the business combination arrangement, because of whatever reason, is there an obligation on the acquirer? Means, does Walmart has the responsibility to replace the awards, replace the share-based payment award? If the answer to this is no, means Walmart did not have any obligation. They just simply said, okay, we will give you this award. In that case, you will take the entire thing as post-acquisition expense. You will take the entire thing as post-acquisition expense. If the acquirer is obliged to replace the, or if the acquirer is obliged to replace the award, then we have to split that between pre-combination service and post-combination service. Now, how do we do that? Pre-combination service means, see here, in the example that I told, 3 years was the vesting period. 3 years was the vesting period. 2 years have been completed, right? 2 years have been completed. So, when I am replacing partly for the 2 years completed, and I am replacing partly for the 1 year which is left. So, what the standard says is, the pre-combination service is the original fair value, whatever is the original fair value, into what is the period completed, divided by either the old vesting period or the new vesting period, whichever is higher. So, original vesting period which is completed multiplied by the fair value divided by the higher of the total or new vesting period. That is the pre-combination part. What is the post-combination part? Post-combination part is whatever we have given the new award, what is the fair value minus what is the pre-combination part. So, if there is an obligation on the acquirer to replace the award, replace means what? We are exchanging. Replace means what? We are exchanging. So, if you are exchanging and if you are obliged to replace, we have to split that between the pre-combination service and the post-combination service. Now, how do we calculate the pre-combination service? Original fair value, how much have been completed, divided by higher of total or new. Post-combination, whatever was the original award minus whatever has been allocated to pre-combination service. This has been tested time and again in the examination, and this component will go as a purchase consideration, this component will go as a post acquisition expense. Okay, now we'll take one question on this and actually solve it from the examination. That will help us understand. Just give me a moment. So this adjustment, I'm just taking the adjustment because that is what is relevant. This adjustment comes from your May 22 question paper. Okay, May 22 question paper. K Limited had certain equity settled share-based payment award, original award, which got replaced by the new awards issued by J Limited. As per the original terms, the vesting period was 5 years, and as of the acquisition term, the employees of K Limited have already served 2 years of services. As per the replaced award, the vesting period has been reduced to 1 year from the acquisition date. The fair value of the awards is given below, original and replacement award. Now here, what has happened is K Limited has acquired, J Limited has acquired K Limited. J Limited has acquired K Limited. Now, to the existing award holders or existing ESOP holders, what the company has done is they have given a replacement award. Replacement award means you cancel out your existing award and we are giving you the new awards. We are giving you the new award. Now, when you are giving the new awards, how do we account for it? We have to split that between old and new. We have to split that between vested period, that is the period already completed, that is the pre-acquisition period, and subsequently how much is the post-acquisition period, right? Now, how do we allocate? See, pre-acquisition period award means the period which is already completed. How do we calculate that? Fair value of the original award, 6 multiplied by vesting period completed, 2 divided by higher of, what is it? Higher of what? Higher of original period. Original award is how much? 5. How much is the new period? See, we have already completed 2 years. How many years are left? Now we have left with 3 years. But now that has been reduced to 1 year. That has been reduced to 1 year. Means old one is higher. So 6 into 2 divided by 5, which gives me 6 multiplied by 2 divided by 5. This gives me 2.4. Now this 2.4, what do I do? This 2.4 will form part of my purchase consideration. The 2.4 part, this will get added to my PC. This will get added to my PC. Oh, sorry, I didn't share the question. I'll do it again. So, in a flow, I just missed it out. Yeah, I'm sharing it again. In a flow, I missed it out as I'm doing that part again. So, this particular question taken from May 22 examination, one of the adjustment, okay. K Limited had certain equity settled share-based payment award, original award, which got replaced by the new awards issued by J Limited. As per the original terms, the vesting period was 5 years, and as of the acquisition date, the employees of K Limited have already served 2 years of service. So, originally it was granted for 5 years. We have already completed 2 years. So, portion that is pertaining to the completed period is the pre-acquisition component, that is a part of our purchase consideration. As per the replaced award, the vesting period has been reduced to 1 year. So, 5 years was the original period, 2 already completed, means 3 is left. That 3 has been reduced to 1 year. And the fair value of the award is 6 lakhs and 9 lakhs. How do we account for it? Now, pre-acquisition period portion is original award value into what is the period completed? 2 years divided by higher of original terms and the new terms. Now, what is the original term? 5 years. Now, new term 1 year. So, you will consider higher of that, which is 5 years. So, 6 into 2 divided by 5 is 2.4. That is added to the purchase consideration. Then, what is the post-acquisition period? Post acquisition part will be 9 minus 2.4, which is 6.6. Now what do I do with the 6.6? That 6.6 will be considered as a post acquisition expense whenever you issue. So this is as a 1 year period, so that 6.6 will be expensed over that 1 year period. So that is with respect to share based payment award. Very, very important. Looks simple, but see, the issue with these kind of questions is, if you miss out or if you do an incorrect adjustment of this particular adjustment, your purchase consideration will be wrong, your goodwill will be wrong, and entire other aspects will also go wrong, right? So this part, which is the pre-acquisition portion, that will be considered to be a part of your purchase consideration. Are we clear with this? Any questions? Now, the next doubt that might come to your mind is, so where do we show, or where do we give the second part of the impact? The second part of the impact will be given to equity. So when we do share based payment, that will understand that how we report this. So this will be reported under other equity. So let us also look at other adjustments which we have already discussed from the same question. And if you see, the patterns of the questions are pretty much similar in all of the examination. Most of the examination you have similar pattern. Okay, so I'm taking the other adjustments also. First, fair value of property, plant and equipment was 425. So this is an increase or decrease in fair value. You have to check that and you have to do the calculation. Then J Limited also agreed to pay an additional payment as consideration, that is higher of 45 lakhs and 30% of any excess profits in the first year after acquisition over its preceding 12 months made by K Limited. This additional amount will be due after 3 years. K Limited has earned 15 lakhs profit in the preceding year and expects to earn another 20 lakhs. Now here what they have said is, J Limited has agreed to pay. Now this is a consideration which is contingent. This is a consideration which is contingent. They have agreed to pay how much? 45 lakhs and 30%, whichever is higher. Whichever is higher. Now, the contingent consideration, whichever is higher, please understand, even if we do not consider the increase in profits, what is the minimum amount that I need to pay? See, there is one amount based on performance, but minimum amount I need to pay is 45 lakhs. When is that 45 lakhs due? That 45 lakhs is due after 3 years. So the 45 lakhs after 3 years will be considered to be a part of the consideration, because see, future expected earnings I don't know, but 45 lakhs that I need to pay, which is the consideration, that part I need to take fair value of that. I need to calculate fair value of that, and that needs to be accounted for as my purchase consideration. Now 45 lakhs discounted for 3 years period. 45 lakhs discounted for 3 years period, that will be the part of my purchase consideration. Is there any doubt? Now, sir, why did we not consider the extra earnings? See, the extra earnings, that is 30% of excess profit. Okay, so 30% of excess profit is how much? 5 lakhs or 30%. The higher amount, the minimum commitment itself is higher. So 45 lakhs is higher. We will provide for 45 lakhs. Then J Limited has also agreed to pay one of the founders' shareholder a payment of 22 lakhs, provided he stays with the company for 3 years after acquisition. So we will pay 22 lakhs, but for what purpose? If you stay with the company for 3 years, only if you are in employment for 3 years, which means this is a payment for employment and this is not a payment towards acquisition. If the condition was that whether or not you stay, we will pay you 22 lakhs, then in that case, it would have been a case of purchase consideration. Then fourth point we have already discussed. Fifth one, K Limited had a lawsuit pending with a customer who made a claim of 70 lakhs. Management reliably estimated the fair value of the liability to be 7.5 lakhs. Now, this fair value of liability, which is 7.5 lakhs, will be considered when you calculate the net assets, because that is the fair value of your contingent liability, right? Sir, it is not given whether it is probable or not. By looking at the question, we can say that there is a fair value which is attributable, there is a, probable payment that can happen, and the fair value of 7.5 lakhs will be considered to be the contingent liability portion, and that is the amount at which you will calculate the net assets. So you'll reduce it from the liability. So this completes the questions, adjustments related to discussions what we had yesterday. Do you have any more question? Have you understood whatever we have discussed so far today? Okay, understood. Thank you. Right. Now, moving on to other smaller aspects of adjustment, measurement period. Now, what is this measurement period? See, sometimes what happens is, because I need to calculate the fair value of the assets, the fair value of so many things, I am not able to calculate them on the acquisition date, because the fair value I have to calculate, right? What is the fair value of each asset and all of that. So if I am not able to calculate because information is not available on the acquisition date, we get a period of 1 year. We get a period of 1 year, and in that 1 year, what we can do is, initially we can do the allocation on a provision basis. Means we can determine the amounts on a provision basis. Then, as and when we get new information about facts and circumstances that existed on the acquisition date, very important. It is not that subsequently if the amount changes, we'll adjust the amount. Not that way. We have to see what was the information, or what is the facts and circumstances that existed on the acquisition date. If I've acquired on 1st of April of, let's say, year 23. On 1st of April of year 23, I am not able to determine certain information for certain items. Subsequently, what I can do is, if I get more information about what? About facts and circumstances that existed on 1st of April. Not subsequent transactions. On 1st of April, whatever were the facts and circumstances, what is the additional information about those? As and when we know, we will adjust those amounts, and the impact will be given retrospectively. For example, we were not able to determine the fair value of land. We didn't get the stamp duty valuation, we didn't get the valuation report, we could not determine fair value of the land. So provisionally, let us say we accounted for it at 10 crores. Subsequently, we got to know that on 1st of April, the fair value was 12 crores. So we will adjust it. We will increase the value of the asset. So as and when we get additional information, we will recognize additional assets and liabilities. But circumstances must exist on the acquisition date. I am not saying that after 3 months the value has increased. I am saying on 1st of April the value was 12 crores. So accordingly, we will do the adjustment. And the measurement period, so this period is called measurement period, means the date of initial recognition or initial acquisition date, for a period of 1 year, only that is the period that is available. You have to get whatever information you get, you have to account for it, but that period shall not exceed 1 year from the date of acquisition. So if there is any information that you have received for the circumstances that existed on the acquisition date, you will adjust it against goodwill. However, after the measurement period ends, anything that is whatever has happened or whatever new information you get, you will account it as an error as per Ind AS 8, changes in accounting estimates and errors. Now what does this mean? This means that from 1st of April till 31st of March, within 1 year, do whatever you have to do, get all the information and update your numbers. Sir, we could not get the information in 1 year. After that, you consider that it was a prior period error and account for it as per Ind AS 8. Now, what will be the impact and how will the impact be given? Let us take few scenarios. Let us say, date of acquisition, land, we have considered 10 crores. Subsequently, we determine that the fair value land on 1st of April is 12 crores. Now I am increasing the asset. Please remember, my goodwill formula is what? Goodwill formula is purchase consideration plus NCI minus fair value of assets, net assets, right? If I increase the asset, my goodwill will go down because this negative part will increase. So if my land value has increased, what will I do? I will say debit land by 2 crores, credit goodwill by 2 crores. So what if goodwill becomes negative? Then of course it becomes the bargain purchase. Are we clear with the measurement period transaction or measurement period, subsequent measurement period? Now, so there's some exceptions which we had said that we'll subsequently understand them. Now, indemnification asset. Now, indemnification asset basically means that, for example, there is a liability. Somebody has filed a case against me or against the company which is being acquired. Okay. Now, there is a liability. So what the seller says is, see, if there is a lawsuit that happens, I will compensate you. If you have to pay, let us say 5 crores, the seller says, I will pay you 5 crores. Customer has filed a case against the seller. The buyer has acquired the seller. Now, the buyer becomes responsible to the customer. So, what the seller says is, if at all this liability comes up to 5 lakhs, I will compensate. Okay. So, what happens? On one side, I am saying there is a contingent liability. On the other side, I am saying there is an indemnification asset. Indemnification asset means the other party will compensate me. The other party will compensate me for the liability. So, what I will do is, if the fair value of the liability I am measuring, let us say, is 1 crore, I will also have an indemnification asset called 1 crore. If the fair value of the contingent liability is 7 crores, my indemnification asset will only be 5 crores because the other party has agreed to compensate only to the extent of 5 crores. So, whenever you have this liability, when there is a liability, against that if there is an indemnification, you will also recognize the indemnification asset. But at what value? If the liability is lower, then at the lower value. If the liability is higher, to the maximum value. Okay. So that is what happens in the case of indemnification asset. Then coming to leases. Now what is the case of lease? Sometimes what happens is the seller or the buyer has given something on lease to the seller. So acquiree is a lessee. Acquiree is a lessee. Meaning to say I have a property, I have given it on lease to the other party and I have acquired the other party. Now, in the other party books, as per Ind AS 116, we have understood that there will be right of use asset. There will be right of use asset. There will also be lease liability. So, how do we account for it? We will first recognize right of use asset and lease liability for leases as the same amount as the lease liability. Okay, because sorry, this is not the contra adjustment. This is about acquiree being a lessee independently. I misinterpreted the example that I was giving you. Acquiree is a lessee. See, if I am acquiring my own thing, that will obviously cancel it out. Acquiree is a lessee, is a third party lessee. So, the acquirer shall recognize right of use asset and lease liability for leases at the same amount as the lease liability, adjusted to reflect favorable or unfavorable market terms of the lease when compared with the market. So, whatever is the right of use asset and whatever is the lease liability, at the same valuation you will recognize. So, how do we do the recognition for adjusting this favorable and unfavorable market terms? You will see what is the present value of the remaining lease payment if it was a new lease on the acquisition date, and less than 12 months you can have the exceptions, you can consider it. If it is a lessor, that is, lessor has given it on lease. So when lessor has given it on lease, the lessor will have something called as lease receivable. So In measuring the acquisition date fair value of the asset, acquirer shall take into account the given terms of lease. You do not recognize a separate asset or liability if the terms of operating lease are either favorable or unfavorable when compared to market terms. So if you are lessee, you will make the adjustments for favorable or unfavorable market terms. If you are lessor, you will not make that adjustment. Then assembled workforce. Now this is one thing which is very, very important. Assembled workforce conceptually. Okay, all of these are generally not much tested in the examination. Conceptually, if you see assembled workforce, how do we account for it? Now when we say assembled workforce, let us say TCS, we are acquiring TCS. When we acquire TCS, we are also acquiring its employees. Now we do not put a separate value, on the workforce of the acquiree. We do not put a separate value on the workforce of the acquiree. Then what do? We will consider the value that we are paying for this assembled workforce as a part of goodwill itself, because assembled workforce is not a separately identified asset. Assembled workforce is not a separately identifiable asset. Then reacquired rights. Now this happens in case where I have given some rights, or I have licensed some rights to the acquiree. Let us say I am the buyer, the other party is the seller. I have given a franchisee right to the acquiree. Now in that case, what do? See, I have given a franchisee right to the acquiree, and I am reacquiring the same rights. In that case, there is an exception of measurement which says that the acquirer shall measure the value of reacquired right as an intangible asset on the basis of remaining contractual term of the related contract. What is the meaning of that? See, it is my license. I have given my license to another party, franchisee license to another party. What I have to do is, I have to determine the fair value of this franchisee license and account for it as a separate asset when I am doing the acquisition. Now, it might sound illogical because I am reacquiring my own business. I am reacquiring my own license. When I am reacquiring my own license, why should I account for it as a separate item? So that goodwill is properly valued. Hence reacquired rights are recognized separately. Any intangible asset, if it meets the identifiability criteria, we recognize it, whether or not the selling company has recognized those transactions. Then share-based transaction, we have already understood, and assets held for sale are measured in accordance with Ind AS 105 at fair value less cost to sell. Please remember, when we put the general criteria, what did we say? General criteria, we said that the accounting will be, or the assets will be valued at fair value. Initial date acquisition, assets will be valued at fair value. That is what we have understood, right? Now, if initial date we are doing it at fair value, as per Ind AS 105, it is fair value less cost to sell. So we will have to do it at fair value less cost to sell only. We cannot do it at fair value. So that is where it is a difference, right? Not frequently tested in the examination. Okay, so intangible assets we have understood, share-based payments we have understood, assets held for sale we have understood. Not frequently separately tested in the examination, but important conceptually, sometimes one hidden adjustment may come up in the examination, and that is where we have to be extra thoughtful, right? Now, the aspects related to whatever we have discussed so far, and the key to score best in this chapter is to practice as many questions as we can, especially after we finish the consolidation chapter. Okay, so once we are done with the consolidation chapter, as much as possible, you should practice. I will be dealing with a couple of more cases. One, a comprehensive question. Second one, a question on reverse acquisition. Okay, those two aspects I will be dealing with, which we will be covering in the subsequent period. That is, if one is a common control business transaction, also will be covering, and reverse acquisition will be discussing. Apart from that, please practice all the past examination papers from this particular chapter. Highly scoring, you will be able to score 15 out of 15 or 20 out of 20. I have confidence in that, but with proper practice. Now, another thing is, don't boil too much into the theory, because it will tend to confuse you. Our objective is to, of course, understand and pass the exam. Right now, the focus is on passing the examination. So focus should be on more and more problem practice rather than, doing a deep dive into the theoretical aspects. Any questions? Okay, no questions. So tomorrow we'll continue with one reverse acquisition example and then common control business transactions. Okay, thank you.